We'll go ahead and get started. I would like to call to order the meeting of the Investment Advisory Committee for July 24th, 2024. First, we will have roll call.
Chief Ronayne?
Eric
Eric
Janis
Janis,
here.
sorry.
Yep, that's okay. Here.
Councilman Schron?
Here.
Treasurer Cromas?
Present.
Okay, very good. We do have public comments up next. I will ask for, Brad, I don't know if you'd be willing to do a sort of summary of the rules of public comment, or if somebody can do that on my behalf, that'd be great.
Yeah, I'd be happy to do that. Thank you, Mr. Chairman. So in the packet, you will see a proposed set of rules for public comment. This will not govern today's public comment period, but it is aimed at public comment for future meetings, starting after this one today. So this is consistent with some of the conversation that council has had recently in this space. So you should have a copy of that in the packet. It would be effective again at the next meeting of the IAC.
Okay, I think just to close the loop on this, let's go ahead and put this on the record as a motion. I hereby move that we adopt the public comment rules as has been suggested for the future, and they'll be effective at the next meeting.
And I will second that.
All those in favor, please signify by saying aye.
Aye.
Aye. Any opposed? Motion carries. Thank you. Next, we will have the public comment section.
Rochelle Roth.
Good morning.
There's probably a button on there. There you go.
And I'm sorry, before you start, can we just reiterate the rules of the speaking? I think we have a 3-minute limit. Is that correct?
Yes, 3 minutes, correct.
3-minute time limit. Okay.
I'll be even less.
Very good. Thank you. And if you would, as you come up, state your name and where you're from. Thank you.
Okay. My name is Rochelle Roth. I am a resident of Cuyahoga County. I was asked to speak here on behalf of the group from the Jewish community. We just want you to know we appreciate that you and Cuyahoga Council representatives have listened so patiently at so many meetings concerning the topic of investment in Israel bonds. We all know that Cuyahoga County elected officials are not responsible for international affairs. These issues are distracting and interfere with the important work council members want to do on behalf of Cuyahoga County. I specifically want to thank and compliment the Investment Committee, all of you, for doing such an outstanding job on behalf of the county and its residents. I reviewed the investment portfolio recently, and I applaud the diverse investments and returns you are generating. And Israel bonds happens to be one of the highest performing investments in the portfolio. So we just want to say thank you, great job, and keep up the great work.
Thank you.
Tom Lokshin.
Hi, my name's Thomas Lokshin. I'm the Executive Director of Israel Bonds for Ohio and Kentucky. I'm a Cuyahoga County resident, and our offices are regional offices in Cuyahoga County. I'd like to thank Cuyahoga County for its long-term investment in Israel bonds. I sold the first bonds to the county in 2006, so it's 18 years of being a strong investment and enhancing the county's portfolio. I want to thank the concerned citizens in Cuyahoga County for attending today, because there is a strong interest in continuing for the county to continue to invest in Israel bonds. We have a 72-year history, and in that history, on Israel bonds, it's always paid every payment in full and on time, and never defaulted on its debt. And it's a good, solid investment, and will continue to be in the future. So thank you for the past, and thank you for the future of Israel bonds with Cuyahoga County.
Thank you.
That's all we have for public comment today.
Okay, very good. Thank you. And thanks for those in attendance. We'll move on with our agenda. Next up is the approval of minutes for the January 25th meeting.
I hereby move that we accept the minutes and approve them.
Well, second, I do have a discussion item, though, just a quick correction.
Okay.
So under item 5 in the minutes, we have Executive Ronayne asking for a motion to accept the minutes. I assume that means he appeared at the meeting after it started, so just want to make the note that we note that somewhere in the record copy.
It has been moved and seconded. All those in favor, please signify by saying aye.
Aye.
Motion carries. Next up, we will have our fund and portfolio discussion.
Yeah, and Mr. Chairman, for the benefit of the audience who's probably, this might be your first and exciting investment advisory committee, we will now be going through the portfolio. We're giving you the background, what we do, and where all the investments fall out, so that this is the functional part of the meeting. Sorry.
Thank you, Councilman
I know
Sherman.
you're,
Okay, if you turn to page 2 of the portfolio review, second quarter, we have under our general funds, those are the Star Ohio ARPA main funds and the 3 banks. Those are our main operating banks. Key Bank is our primary operation. All money that flows into and out of the county flows through Key Bank. PNC and US Bank also hold other accounts related to auto title, lodging. They take our credit card payments both through Point and Pay, our vendor, and directly through the website. The funds in Star Main, that's where we funnel all our money from Key Main to Star Main, and then we make our investments or allocate it to other funds. The meter team is going to discuss the investments after Jed talks about the opioid fund, which is on the next page.
So the opioid fund, as you can see here, we use this to fund the opioid diversion center to kind of push back against that opioid epidemic that we're still going through. This is the structured investments that you see here before you. As investments mature and we get coupon payments, we are able to invest those at a 5-year timeline because we've structured maturity so that we can fund that diversion center for the next 5 years.
before going on to the opioid page, I was wondering if you're going to open it up for questions on the previous page.
Absolutely.
Only because it's obviously been an area of comments and conversation. The foreign notes that we're showing here are the Israeli bonds.
That is
correct.
15.9, and it shows a 1.145 percentage, and we are authorized to go as high as 2%.
Correct.
Okay, so we could, in theory, take that up to potentially as high as 22?
Correct, 22
to
million.
23 million, correct?
Right, another 6.8 million.
And my understanding is that those bonds have, within the last, I don't know, last 4 to 5, 6 weeks, have bumped as high as 6.2%.
6.2% for the interest rate.
Do we have anything paying 6.2%?
We do not.
Okay, thank you.
Any other questions? Okay.
So as I was saying here, we are currently investing in the 5-year horizon with everything that matures, the coupon payments we receive. The last coupon we purchased, or the last bond we purchased, was yielding about 4.3%. So that we're still getting good returns. We want to lock those in as this opportunity remains for as long as it does so. Next slide, please. This is the Star Ohio daily rate. As Lena was mentioning, money that we do not need for immediate operations, we swing over to Star Ohio to get some overnight rate. As of yesterday, the rate was 5.57%, and we can see on the bar on the right side of that slide the rates that we've seen over the years. So we can see how it's gone up and expect it to start going down, but that's something that Meter will get into more detail on in a moment.
Okay, and if that concludes the presentation on funder portfolio, do any of my colleagues have any questions?
Only on the last slide, Mr. Chairman. In regards to Star Ohio, you indicated that our annual yield is 5.57 or 5.59, and it's dropping to 5.57. So that means it's trending down, at least temporarily. Might not be for long term, but what is your expectation?
Expectation is for rates to start going down. It's going to tie pretty closely to what the market's expecting rates to be. The average maturity, you can see there, is 46.5 days as end of quarter. I think this morning when I checked, I think it was 49.7. But we're right there on the 50-day average maturity. And so it's going to respond much quicker than our bond prices. That's why we want to lock in bonds at a higher rate for a longer period of time to try to take advantage longer term of these higher interest rate environments, because they are going to start tapering down. The Fed's showing some indications of rate cuts in the next meeting.
So the sooner we lock in long-term rates versus this drop is going to be dropping like a stone, I have a feeling, pretty soon. As far as, well, not necessarily like a stone,
agree
but
with that. Not quite like a
it's going to
stone,
migrate downwards.
Right, correct.
Okay.
It'll trend downward.
Thank you.
Thank you. Any further questions? Okay, hearing none, we'll move on to our next agenda item, which is an investment discussion. We have Jason and Jason from Meter.
Good morning, everyone. Thank you. One quick note here, typically Jason Headings, another member of our team, is in attendance. He is out, his wife is having a baby. So Jason Headings, who does fill in and join us from time to time, is joining in his stead. So I'll turn it over to Jason Zabo to walk us through an economic and market update this morning.
Thanks, Jason. So yeah, I guess we'll piggyback on some of the thoughts of stone dropping of rates and market expectations, and really go into the next slide of walking through from really a high level view of what some of the Fed members have been talking about and across the economy, what economists expecting, to really give an external view of what other folks are viewing and understanding and summarizing what they're viewing from an economic perspective. And really from a Fed funds rate side of the house, Jerome Powell, as we talked about from the prior meeting, Q1, we had different outcome from what the Fed was expecting from the inflation front. So we saw here in this next quarter, the Fed was really emphasizing the need for patience with regard to cutting rates. So you saw a lot of commentary from March to really May of the Fed really leaning into that data dependency and looking for inflation to have a better outcome. So they've communicated, hey, maybe they're only going to cut rates one time in 2024, which was significantly different than the 3 cuts they penciled in to start this year. And then similarly on the inflation front and piggybacking on some of the Fed commentaries, they saw Q1 inflation being slightly higher than what was anticipated. Powell and some of the Fed members started to think and pencil in perhaps maybe we won't get to the 2% target until 2025 or perhaps 2026. When we really view this more as is interesting of somewhat of a sentiment factor from how the Fed has evolved their thinking in terms of how difficult the inflation environment was in Q1, and having seen some success in Q2 that really altered perhaps some of their longer term view of getting to that target. Now flipping over gears to the growth side of the house, and we'll touch on some of these points in greater detail as we go through the presentation, but we have economists are forecasting and anticipating a different growth environment for the year of 2024 than the year of 2023. However, with this slower growth expectation, economists aren't seeing real significant signs that we'll be in a recession in 2024. However, just really iterating the difference from how the economy is operating from 2023 to 2024 is just really significantly slower than we saw last year. And then similarly, a big change from what the market and the Fed is looking at in experiencing a different labor market. The big story of last year was employment was really tight. Wages were certainly elevated. However, throughout the course of this year, the labor market has continued to loosen, and we've seen the unemployment rate tick up a couple tenths of a percent this first half of the year. And then, lastly, from a yields and interest rate perspective, given the Fed has been really data dependent and emphasizing that and leaning into this idea of being patient. We've seen yields really being a range bound environment, giving investors a continued opportunity, as mentioned previously, is to really lock in these longer rates that we haven't seen since 2007 time period. Given the patient outlook from the Fed, there's just giving more time to lock in rates before we start to see the Fed adjust policy lower as we move forward. So moving over to the next slide and can dive a little bit more in detail from a rates policy expectations perspective, where this is the market pricing in with a view, the next path from the Fed. And, on a high level, I think it's become really evident from this chart is as you look through 2024 and throughout 2025 is really leaning into this idea that the economy is significantly different than last year. The inflation backdrop is significantly different, and the market is really anticipating that the Fed is going to start to reduce interest rates in this year, but really more importantly, as we go into 2025, a significant change from Fed funds and short-term interest rate policy perspective, where we're going to see more rate cuts as we move over to the next calendar year. Now, one of the interesting dynamics as we go to the next slide is very topical in the marketplace right now, and then also within the news is, what's the timing of the next cut? And there's this, we have a meeting here in July in a couple of days where broadly there's no expectations for the Fed to cut rates, and the real debate of when the timing of the cut is going to happen, is it November or is it September? And as we move over to the next slide, I really kind of hit on this point of why there's such a debate is the November meeting is 2 days after the general election. And there's this wondering, is the Fed going to be political in terms of how they're approaching monetary policy? And it's been a big theme of the market trying to price in September or November. In our view, and looking at a number of different studies and going through the course of history, there's largely been no evidence of the Fed being political as it views managing the monetary policy. So there's been different election cycles at the federal level, midterms, non-election periods, and you just can see the Fed funds rate has changed in all different time periods. So really a lot of data and support that the Fed really is doing what they think from a data dependency perspective is necessary to meet their mandates. And to hit on another point of really somewhat more recently, if you go back to 2012, for further evidence that the Fed doesn't think about managing policy from a political perspective, is 2012, we had another general election, and obviously in November, but we had the Federal Reserve enact in September of that year, so just 2 months before that election, re-announcing when rates were at zero, going into the third round of quantitative easing. So just another evidence that the Fed is not considering the outcome of the election when they think about policy, because they've done it in the past of raising rates and lowering rates and doing other forms of monetary policy, and they're really in the best interest of their view of what's the data telling them and what's the important policy change that will reflect the two mandates.
Jason, can I interject with a question?
Hmm?
So on page 3, where you've got your federal funds projections, you have the note here that the futures market's implying 0.75% cuts between now and the end of the year. But I'm also hearing you circle 2 dates and saying we don't expect anything to happen in August. I just don't know if can you speak a little bit to where that third cut might be? I'm hearing September, November. Where are we expecting that other 0.25%? Or are we expecting a 0.5% move? Can you just, unpack that a little bit?
It's to not go too terribly into the math on the futures market side where the probabilities can get a little bit difficult. It's really this idea of if they go in, the Powell raised the point last meeting that they're taking the first cut very seriously because they think that's going to be consequential and will likely set them on a path to do them either monthly on a quarterly basis. So what we're really seeing from this calendar year is from a market timing perspective, and this is just a snapshot as of July 15th. This third date really comes in between December and January 2025. So it's a function of if we're going to get the first cut in September or November, and that pushes the 3 into this calendar year versus it leaking into the first month into January. And then really, I think from a market perspective, and we're really honing in on is we're going to get a lot of evidence of the Fed setting up the market for the first cut between September and November. Once we get the August CPI data to come in next month, it would really set the stage for the Fed to have 3 consecutive months of positive inflation data to have the necessary confidence to start cutting in 2024 and give them strong cues as to when they're going to sort of lift off this cutting environment.
Great, thank you.
Then I think if we go over to the next slide, we'll actually get into a little bit more on the inflation front. So really on a high level, the inflation environment obviously significantly different than we saw at the beginning of 2022 when inflation was at that 9% from a CPI perspective, and core PCE, which is the Fed's preferred measure, was close to 6%. Their year-over-year numbers have come down significantly and getting more on trend with the expectations from a mandate perspective of getting closer to that 2%. And really the big takeaway, important point we're going to hit on is the stark difference between Q1 when inflation was surprising to the upside. Here in Q2, inflation between both the CPI and the core PCE measures have been coming in below expectations. So we're really seeing a big shift from a data dependency perspective that inflation has certainly been resuming its downward trend that we saw in 2023, where the Fed was really anticipating more cuts in 2024. Obviously, we've had that little bit of a U-turn in Q1, but we certainly resumed the downward trajectory from a month-to-month perspective. And we've seen a lot of the FOMC officials really highlighting the positive inflation data, and then specifically on 2 core areas that have been really welcoming from a policy perspective is the shelter front, which has been a significant lagging effect on some of the CPI and PCE data. We've seen for the last 2 months, the shelter component increase at its slowest pace since 2021. And then also a big measure from inflation perspective is that supercore measure, which is really there to measure what's going on in the service sector and excluding anything tied to shelter. We've seen 2 consecutive months where there's been deflation in its supercore measure, which has been an area where the Fed has focused a lot of their energy in giving them confidence that they will likely see inflation continue to fall closer to that 2% target over time. So again, a lot of positive outcomes and a big difference from Q1 to Q2 is inflation is going back to that prior deceleration that we saw to start the year.
Jason, question, Jack Schron.
Yep.
And by the way, it's kind of nice when you throw out the word Jason, I catch all 3 of you guys whenever.
Yeah.
Is that the universal name, I think, at meeting out there?
We aim to please.
Yeah, okay. When you go back to your previous slide that talks about potentially 3 rate drops, even if there are only 2, when that starts to happen, what happens directly with the fixed rate long-term investments and the bonds that we might own? What
Yeah.
direction do they start moving?
They'll go down. So
Okay.
the market is anticipates the future. And the moment there's further evidence that front end policy rates are going to come down, the market will get ahead of that and move significantly lower before the policy actually even shifts. So as we noted earlier, it's really the benefit of an importance of locking in these rates today is once you get the evidence and they make the decision, the rates have moved significantly lower well before, that policy, meeting actually occurs. So yeah, it goes back to the importance of locking in rates today and what we've been doing for the last 6 to the last year of taking advantage of these rates before, the market moves significantly lower.
So the purpose of this committee is to not only pass the rules for the investments of the county, but it's also to provide advice. And you're giving us advice that when that starts to happen, it's going to accelerate, and it's actually going to happen before then. It sounds to me that the rates are going to drop on our long-term investment opportunities. So if don't want to read between the lines, but my understanding of your suggestion is perhaps to be locking down some of these things now before that first rate drops, because it's already going to be that will already be too late to catch these things at the highest we can catch them at. Thank you.
I think, well, just to piggyback on those comments, well said. And yes, that has already occurred. For example, I mean, you look at 5-year Treasury rates, we're off 50 to 60 basis points, roughly saying a half a percent. Those moves have already occurred. So yeah, and moving through the portfolio, which has been a regular theme within our recommendations around reinvestment of the portfolio, is looking at those longer term, looking to lock in those longer term securities, certainly as is appropriate with continued and appropriate diversification across the entire portfolio.
Yeah, which is the purpose of this committee and the advisory, is to actually provide the best return for the taxpayers in regards to our portfolio. So I agree with your comments.
Excellent. Then I think if that addresses those, moving over to the growth side on the next slide, again, reiterating that the beginning point of the presentation is, big difference from a GDP growth perspective. In 2023, the economy was operating close to that 3% growth rate, and economists on a go-forward basis are recognizing the weight of monetary policy, what's some of the outcomes for consumers and how they're behaviorally different, that the expectations for the remaining parts of this year and then starting into Q1 of 2025 is the growth environment to be significantly lower. And this is a necessary condition in a rationale between the need for the Fed to start to adjust policy. We've seen success on the inflation front. We're getting closer to that target and that mandate. However, now there's becoming a greater concern from the Fed when it comes to the slower growth environment, because they want to achieve this soft landing, the idea of getting inflation back to the mandate without causing a recession. And they're getting more concerned given what the consumer behavior has been, the lack of some of the activity on the business side, is that growth is starting to moderate and moderating lower than, their long-term GDP potential growth rate. So the Fed is becoming more mindful, given the data and market forecasts are for GDP growth to continue to come in lower than we saw in 2023. And then moving over to the labor market on the next slide is really, something important. I can hit on, local aspect of it, but really what's happening at the national level, we've seen employment growth slow significantly, and also the unemployment rate that is starting to rise. So we've gone up a number of attempts at the federal level, which we've seen a very similar outcome at the state level. And so then, not surprising, at the county level in the last couple of months, we've seen the unemployment rate tick up a couple percentage points, which is not unsurprising, given we've seen at the national level, state level, local levels that the rate of hiring is coming down, and we're seeing layoffs tick up slightly. So the idea of loosening the labor market has continued to occur, and there's just been significant evidence when you look at the national level, state levels, and then at the local level, but not terribly dissimilar from a national level of what's happening at the county. And then at the last side is, I guess, reiterating what was previously thought of and looking at is looking at the various some yield curve measures and looking at the 2-year and 5-year Treasury rates. And really the big point on this slide is the perspective of, I guess, hitting back to what the market does before and around when the Fed cuts rates. In this chart, there's really 3 peaks of yields going back to 2006 and 2018, and then in here recently is when you see that big drop into 2-year and 5-year. That's right before the Fed begins that policy cutting stance. So again, further evidence to those points earlier that the market moves quite rapidly from a reduction in rates perspective. But the important piece we want to hit on is this longer term perspective where we're at today is rates are elevated. And it's an incredible opportunity within fixed income for income oriented investors is to really have this opportunity to lock in longer term income that we haven't seen in quite some time to support that budgetary aspect of it. And it's a real opportunistic and valuable time within fixed income to be really moving funds out longer. Again, proper diversification, proper liquidity is necessary, but it's really advantageous from an income perspective to be locking in these higher yields that we haven't seen in almost 2 decades.
Jason, Brad Cromis again. Just a quick question on the yield curve itself here, because we're still in an inversion environment, right? And I don't know if you can speak to, if we anticipate any impacts on yield curve normalization as a result of some of these rate changes, if we're just looking at a new normal where this inversion, is kind of with us for a long time. I'd like to hear a little bit more about kind of the projection on that piece. I know I've seen you do that in other presentations, and it's not in this one, but if you can speak to that quickly, that'd be great.
Yeah, so I think from a higher level and ignoring somewhat the timeframes around this, but once the Fed begins to cut, we'll certainly see the yield curve begin its normalization and that be less inverted. And it happens in a slow process, but once we actually get to the point where the Fed is done cutting rates, you'll ultimately see the yield curve normalize with front-end rates being lower than the 2-year, 5-year, and 10-year points on the yield curve. But it's something what we'll likely see really quickly is the overall level of rates will drop across the yield curve, and it'll slightly steepen, but to getting a perfect steepness from front-end rates being lower than a 1-year rate, it'll take some time as the Fed figures out and the market figures out what point are they going to stop cutting rates. Is it going to be 2.5%? Where they have penciled in the target? Do we need to get back to 0%? Or perhaps is it something slightly higher than 2.5? So it'll eventually normalize, but the important piece is the overall level will shift before we get a perfectly positively sloped curve that everybody really enjoys.
Well, and I guess the other piece of that too is, is this the quote unquote soft landing? What does the recession forecast look like if we are looking at one? Is there a projection as to when that's expected? I haven't heard a lot about that recently, so I'm wondering where we're at with that.
Yeah, so this is one of those things that gets us increasingly wary from a sentiment perspective is we went from 2020 coming into 2023, I think every economist penciled in recession was going to happen last year. And then now we've sort of flipped the script a little bit where from a recession forecasting perspective, essentially nobody's forecasting a recession in 2024, but we know there's a number of risks that are out there within the economy, given what we've seen from a consumer perspective. Commercial real estate portfolio, and challenges that are going on that front are still present. So there's a number of risks that can certainly tip us back over to having more concern about a recession. But I'd say broadly, given what is coming on from the business side, and again, consumers are moderating their behavior, but there's not stress to the point that it will be a very clear sign that we're heading for a dramatic slowdown that would result in a recession here in 2024. And our eyes are really on, really what's 2025 look like. But that also will be getting some influence from the election. We're going to have different, perhaps, policy choices that may have some, underlying influence from how, businesses and consumers can operate in 2025. So I think we'll get some good insight as we get into November from a policy perspective and what that influence might look like.
Jason, it's Eric. I have a follow-up question. Notwithstanding the fact that the curve is still inverted with this expectation of changes and normalization with rates being cut eventually, are you still pushing to look at the longest length maturity for reinvestments at this point? So even though a 2-year treasury might earn a little bit more than a 5-year treasury, is it still your recommendation we push out as far as we can on the yield curve or on the distribution curve? Excuse me.
Yes. Yeah. Our recommendation is to continue to go the furthest we can from a policy perspective to lock in these rates for longer.
Good.
And Mr. Chairman, also, you're talking about items of this nature, and have you looked at what's going on potentially in the banking side too? Because I think they're under some pressure from what's going on, because I think that there's some uncertainties taking place there. You might want to take a look at that and see, because I think you're going to see that there's some pressure on that. Again, another reason to lock in long-term rates, because the banking industry, I know, is seeing some pressure, whether it's a recession we hit or whether it's just a flattening out of revenues. It's starting to show up a lot of places.
Yeah, and that really aligns. I think when you look at banks, a lot of times it's a direct reflection of what's going on broadly within the economy. So as we talked a lot about the slowdown, some of the challenges of consumers, when we look at earnings, we have a dedicated team from a credit analyst perspective, looking at banks, looking at non-financials, and really honing on the the bank side. Especially, we just recently got through some earnings with some of the larger banks. Yeah, there's clear evidence that the economy is slowing, consumers are different. We're seeing delinquencies pop up from credit cards, auto loans, and it's directly reflected in banks and bank earnings as well. So yeah, 100% agree with your point that what we're seeing in banks is an area of worth monitoring and monitoring very closely as we normally do.
Any further questions on the economic or market review side before turning it over to the portfolio review?
No further questions. Go ahead.
All right, great. We'll transition over and go through the portfolio review as of the end of Q2. Just hitting some highlights here, as you see, focusing first and foremost on the core portfolio itself. We will transition momentarily over into the opioid settlement fund that Jed gave a summary of earlier. But the portfolio stands as of the end of June at just over $950 million in total value. That being very consistent, which you'll see here in just a moment, with where the portfolio has been, certainly with some growth, some money in, some money out over the last few years. We stand at 2.42 years weighted average maturity, something that we always like to remind everyone of here. We get a bit of an artificial bump higher, not really artificial, but we get of an uncontrolled bump higher because of that longer-term parking garage note that does impact significantly, given the long-term nature of the note. It adds somewhere in the neighborhood of about 0.2 years to the weighted average maturity. So on high, again, standing at the 2.42 in terms of invested securities, standing a little closer to around 2.2 to 2.25 years. The weighted average yield came up from 257 last quarter to 280 as of the most recent quarter end, which puts our estimated annual income, again, this is only for the invested portion in the core portfolio, at just over $26.5 million of interest income. The major moves within the portfolio have already been spoken to a bit as we went through the market and economic update. But the biggest changes in asset allocation have been, we're focusing on two areas. The primary being reinvestment of securities out longer. Those reinvestments are focusing in on U.S. Treasuries over U.S. agencies, as the yield spreads more recently just haven't been there. So there has been a drift down in agencies, a drift up in Treasuries, as well as focusing in just to replenish a little bit of liquidity on the short end in the December timeframe. That is done primarily through the utilization of commercial paper. So again, just looking out at the maturity distribution at the bottom, we have 22% of the portfolio that is expected to mature over the next year, which will be the primary driver for our ability to put securities back to work on a longer term time frame within the portfolio. Now, of note, we did do some additional security swaps throughout the second quarter. We continue to look for every opportunity that presents itself to do that. We ended up having three specific opportunities to sell securities and reinvest into the longer maturity timeframes to make those specific enhancements to the portfolio itself. I'll stop there and open up to any questions around allocation or maturity distribution of the core portfolio.
I actually have a brief question on this page, but I'll direct it towards Mike Chambers. Our estimated annual income now is at 26.6 million here. Do you recall what we budgeted, Mike?
I think Walter's down around 15.
Okay.
Remember, not all this is general fund.
Get you. Thanks.
But it is, we
Okay.
are
On the next slide, a review of the year-end statistics. This is a newer slide that we've added over the last couple of meetings, which just gives that historical perspective. A couple of things again here of note. The portfolio has remained quite consistent from 914 million up to 953 million most recently, from 2021 up through June 30 of 2024. You will see the weighted average maturity has trended down just a hair, again, as a lot of these securities are maturing or aging down throughout the portfolio, but we are actively looking to push that weighted average maturity back out as we continue our reinvestments back out into that 5-year time horizon. And the weighted average yield trend, you see here, we really bottomed out at just under 1% at the end of 2021, and we've had our gradual increase, again, noting the time required to transition this portfolio as the opportunity to go out and sell bonds and lock in losses is not an attractive opportunity for the county. We've all explored that extensively over the last couple of years, but we're continuing to see that increase upward, which is great to see. On the next slide, the direct comparisons.
On your comment, excuse me,
Yes,
on that,
please.
Jason, on your comment about selling and redeploying it, and you said, obviously there's some losses when you do that early. Have we got to the point where it's a break even as far as the losses versus the reinvestment?
Well, great question. There are some opportunities that present themselves specific to those swaps, those security swaps I mentioned earlier, where we're able to do so where it's a break even at least, and we're able to take those out and lock in the yields longer. The challenge is we are still not at the place where we are at least a break even on these other securities where it would make fiscal sense to do so.
Okay, so the swap is not an attractive thing, but finding those that would be out there in years, 3, 4, 5-year maturity and interest rates of 3, 4, 5% would be an attractive alternative to
Exactly.
Thank you.
Correct. On the next slide, the compliance review, everything within the portfolio. This is just a double check of the information presented by the county report earlier, but everything within the compliance of the investment policy on the core portfolio. And then finally, on the next slide, for the core portfolio, the direct, again, the look overall. So again, I like to take a moment here and remind everyone, we're looking at two direct comparisons, one being Star Ohio, which is purely overnight yields. It's going to move up very fast. if and when rates begin to turn over, it will move down very quickly, really in lockstep with Fed fund movement. The benchmark, which was the county selected benchmark that has been in place for a number of years, we've had some discussion around the opportunity or whether or not we should consider some other benchmarks. But to remind everyone, this is a 2-year average of the 2-year Treasury, which effectively means it has a 1-year weighted average maturity. As we just reviewed, where the portfolio for the county has ranged at a high of almost 3 years down to 2.4 years, that weighted average maturity of the county's portfolio is significantly longer than the weighted average maturity of this benchmark. So what it tells us is the benchmark is going to move much faster than the county's portfolio. So again, we're continuing to gain ground. The 2.8 on the portfolio overall, the benchmark at the 443, Star Ohio at 545. Jed mentioned earlier, as of the prior quarter end, Star Ohio was at a 547. So we are clearly seeing overnight rates have peaked out and turned over, which we would expect, barring anything unexpected happening within the economy, that Star Ohio rates will continue to trend down. So again, reinforcing that theme that we have all discussed and agreed upon, the continuing lengthening of the portfolio, reinvesting and locking in these rates for as long as we can.
Thanks, Jason.
One of
And
the things that
I just
go
want to
ahead, Brad,
weigh in on the
please.
benchmark conversation, because that's one of the things that we had started to have a conversation on with the investment policy review we had started to do. So when that
Yes.
topic comes up again, that's something that we'll revisit. To the point Jason's making, is that actually the best metric for us or not, given the volatility short term? That's something we want to unpack, I think, a little more. So just to point that out. And then the other thing I'd mention, I know in other versions of presentations, I have seen the ins and outs being presented in terms of what we've purchased or sold over the course of a quarter. We do that in our monthly report that we submit to the Treasurer of State. I don't want to bury you in paperwork, but if that's something the committee is interested in seeing, at future versions of these meetings, I think we're open to presenting that too. So just to put that offer out there. Thank you.
Absolutely. Yeah,
Your comment about long-term investments and the higher yield that you could see today, that wouldn't be impacted if we chose a different benchmark, though, would it? Your comments about?
No.
So
It
the
would have
benchmark
no
is
impact on what we're
just
looking to
it's a
do.
Kentucky windage we want to put on the map, and we say that's where we want to be, and sorry about that.
Yeah.
You can tells you where I do almost other parts of my life. Having spent 28 years in the Army, but I just want to make sure that if we choose the benchmark, it still does not choose the advice that Jason is giving us on the investments.
Yeah, no impact. And just to highlight that, I think this is a worthwhile point. A metric, we track certainly multiple metrics internally, but one that would be much more reflective of the county's portfolio, just to give a little more detail on this, as opposed to a 2-year average of a 2-year Treasury, we track a 5-year average of a 5-year Treasury, which is going to be representative effectively of a 5-year laddered Treasury bond portfolio, okay? The weighted average maturity of a 5-year average of a 5-year Treasury portfolio is going to be 2.5 years. Very, very close to the county's portfolio. As of current, the average yield of that benchmark is 2.27%. So the county's portfolio is far exceeding the average of that 2.5-year WAM, weighted average maturity portfolio. And that is directly reflective of the moves that we make within the portfolio, lengthening duration, extending or shortening duration, in this case, certainly lengthening. Also picking credits, corporate bonds, commercial paper, municipal securities as they present themselves, the foreign notes. All of those go into really outpacing the benchmark that looks much more uniformly like the county's portfolio. So I think all of that helps add some context overall.
Appreciate that and follow you on that, Jason. Maybe for next time, we can include that as a fourth line on the graph. Love to see it.
Absolutely. Absolutely. If no further questions here, we'll transition over to the opioid settlement fund. The next slide. That portfolio at the end of June stood at just over $62 million. The weighted average maturity here, just a little higher. Jed had some comments around this earlier. We're just over 3 years, looking to be opportunistic and locking in these rates as long as possible. You'll see the positive result, the weighted average yield here at just over 3.3%, which puts our estimated annual income at $2 million. The reason we were able to do that within the opioid settlement fund is over the prior quarters, waiting to get some finalized information over any planned spends around the settlement fund. We had a large chunk of cash that we were able to deploy into the portfolio at one time, which you'll see on the maturity distribution at the bottom of the page. That was primarily, if not solely, used to purchase longer-term Treasury securities within the portfolio, which gave the nice bump and allows us to lock in for those longer-term periods. If no questions here, the next slide is the compliance review of the opioid settlement fund, which again, everything within our compliance ranges within the opioid settlement fund. That concludes my comments for the two portfolios. I'll open up for any further questions or comments.
Thank you very much. Any questions from my colleagues?
No further questions.
Okay.
I'd like to move acceptance of the report as presented then.
Second?
It's been moved and seconded. All those in favor, please signify by saying aye.
Aye.
Motion carries. Next item on the agenda, thank you, gentlemen. Next item on the agenda is other business. We do have one item there, linked deposits.
Thank you, Mr. Chairman. Yeah, just to provide a quick update on the linked deposits conversation, I know that I had shared with this committee and in other forums that we are in the process of reviewing the linked deposit program, which currently consists of HELP loans and Heritage Home loans. The Heritage Home program, we are not looking to do anything with at this particular time, but we are reviewing HELP for some changes, potentially expansion to include small business. We've had conversations with banking partners. We sent out letters of interest to 47 institutions, I think, something along those lines, and have had productive conversations with around 10 of those. We have commitments to participate from 2 and are kind of an ongoing dialogue and conversation with some of our larger partners as to what their participation might look like going forward. So that continues apace. I wanted to bring it up here because I think the time horizon is shifting a little bit. Some of the feedback we're getting from our banks is that their internal review process is going to take another 6 to 9 months for them to get fully on board. My face as well. And then we had conversations about, which tranches of the program make sense for them. Some institutions are interested solely in the home lending, some solely in the small business. So we're kind of recalibrating on that, and we have a conversation scheduled with some of the other members of the executive team that touches on next week. So just to give an update, we're still working on that. It's just, it's progressing slowly, but progressing.
Mr. Treasurer, because you've opened that dialogue, we also had put in a program like 8-10 years ago to actually help communities and school boards. And to be able to do that same thing, their pressure has to be the same as anybody else. And it just seems to me that we ought to really be pushing that and marketing it, because that we can be helping service. We can also be getting a better yield. They can get it. We can go out into longer term. I think we've authorized these to go up to now, I think, 10 years, I think it is.
That's right.
So we ought to, with hearing that advice from our investment advisors, we hold a lot of cards for a community that if they fail to pay us, we fail to give them their taxes. It's a real subtle technique and so everybody wins out there. And I just hope we can put that to work. We did a lot of effort to get that to go, and it means selling, and you got to push that message 6-7 times, as we all know in sales, before somebody's going to buy your product.
Yeah, we've got that program on the books. We haven't done any loans out of it actually over the 10 years. So we've been having conversations about how we can restructure it and maybe find a way to make it a little bit more attractive. Part of the thing that I think is a holdup on that is that that's part of the larger conversation around investment policy. And we're trying to figure out, does this need to be incorporated into the corpus of the investment policy as it exists? Is it a separate side program? But our team is having those conversations right now and trying to figure out how we include that. We're very interested in doing that kind of local support. So
And
same
even
page.
to piggyback off of Brad, we're even consistently looking for communities that need help. And so over the past 15 months that I've been here, we have reached out to several communities that have been in the situation where they needed help, but at the end of the day, they found other assistance through OMAP or other areas that they didn't need. We didn't end up supporting them, but we are willing to do that.
Well, I know, I believe one or two of the counties down in southern Ohio had used that, and it's a total package, not just the money, but you've got to work with the attorneys to get the bond, to get a low cost for those, and just say, hey, this product's not for everybody. It's a repetitive product that we can reduce your costs, and here it is, and get some bond counsel that want to sign on at fixed rates and not be charging the higher rates that they have to charge for bigger, and it becomes a whole package. And I think just like they did a phenomenal job with your office for the Great Estates program by educating people and showing them what you could be doing. It was, if anybody who attended those, that was phenomenal. I think we would get the same result if we were actually pushed how we can help those 59 communities and all the school boards out there. So I think, and you know, it's hard enough to push out a government program and get people to say thank you, but the Great Estates program was truly one that everybody said came out of that with a thank you, because you guys did a phenomenal job with that.
Thank you for your comments, both. Any other items under other business? Excuse me. Okay, hearing none, we are adjourned. Thank you.